معرفة.
Bismillah ar-Rahman ar-Rahim. Now let us discuss about financial screening. Okay, let us discuss about financial screening. Now here we will be looking at a comparative analysis of how different Sharia compliant indices and institutions are using financial screening for investments. Let us first look at the Dow Jones Islamic Market Index. Dow Jones Islamic Market Index uses average market cap. It doesn't use the total assets. So in case of Dow Jones Islamic Market Index, the total debt of the company divided by the trailing average market cap should be less than 33%. In case of cash plus interest-bearing securities, this together divided by the trailing average market cap should be less than 33%. In case of account receivables, the total account receivables divided by the trailing average market cap should be less than 33%. There is no separate mention about interest income, and there is no separate mention about revenue from non-Sharia compliant avenues. Let's move forward and look at S&P. In case of an S&P index, again S&P uses the average market cap. It does not use the total assets. Again in S&P, for debt, it is 33%. For cash plus interest-bearing securities, it is 33%. For account receivables, it is 49%. So you can see the difference. In Dow Jones Islamic Market Index, it is 33, but in S&P, it is 49%. There is no reference about interest income, but there is reference in relation to revenue from non-Sharia compliant avenues. That is 5%. Let's move further and look at FTSE. FTSE does not use average market cap. What it uses is the total assets of the company. So the total debt divided by the total assets of the company should be less than 33%. For cash plus interest-bearing securities, it should be less than 33%, meaning to say the total cash plus interest-bearing securities divided by the total assets, it should be less than 33%. For account receivables, you can see a difference here. It talks about 50%. So the account receivables divided by the total assets should be less than 50%. For interest income, compared to the total income, it should be less than 5%. For revenue from non-Sharia compliant avenues, there is no mention about that. Let's go still further and look at MSCI. MSCI again uses total assets. In case of debt, so the total debt divided by the total assets should be less than 33%. Cash plus interest bearing securities divided by the total assets should be 33%. Accounts receivables 33%. But there is a mention in relation to the revenue from non-Sharia compliant activities. So here it is 5% in relation to the revenue from non-Sharia compliant activities. So it should be less than 5% of the total income of the company. In case of Securities Commission, again Securities Commission uses the total assets of the company. Here it is 33. In case of debt, it is 33. In case of cash, it is 33. There is no mention about accounts receivable. There's no mention about interest income. There's no mention about revenue from non-Sharia compliant activities. Let's go to the last, which is the IOFE, and which is very important. In IOFE, it uses the average market cap and not the total assets. And it is here 30%. In case of debt, in case of cash, it is 30%. In case of interest income, 5%. There is no reference to account receivables, and there is no reference to revenue from non-Sharia compliant activities. So this is in brief a comparative presentation in terms of various important international indices and institution in relation to the financial screening.